Hello traders and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. In today's video, we're going to explore how to combine Bollinger Bands and Keltner channels into a single strategy. This approach helps you identify breakouts, trends, and potential trade opportunities with precision. Stay with me until the end to understand how to set it up, use it effectively, and avoid common mistakes many traders make. So without wasting any much of your time, let's get started. We'll be talking about the Bollinger Bands and Keltner channel. We'll explain them, so stay tuned. Bollinger Bands and Keltner channels are two widely used technical indicators that help you analyze market trends and volatility. While they may look similar at first glance, as you can see on the chart, their construction and applications are distinct, offering unique insights when combined. Bollinger Bands, I'm just going to remove the Keltner channels. Now you see only Bollinger Bands on my chart. Bollinger Band consists of three lines: a middle line, which is simple moving average SMA, and two outer bands calculated based on standard deviations from the simple moving average. These bands expand during periods of high volatility and contract during periods of low volatility. As you can see, low volatility, we have the contraction here. High volatility, we have the expansion, as you can see here. So that is for the Bollinger Bands, and they are particularly useful for identifying overbought or oversold conditions and spotting potential reversals in price movements. For example, when the price touches the upper band, it may indicate overbought conditions, while touching the lower band suggests oversold conditions. Keltner channels, on the other hand, I'm just going to close the Bollinger Bands, and now we can see the Keltner channels. Keltner channels also have three lines but are constructed differently. The middle line is an exponential moving average, EMA, which gives more weight to recent prices, while the outer bands are based on average true range, which is the ATR. This makes Keltner channels less reactive to sudden price spikes compared to Bollinger Bands. They excel at identifying dynamic support and resistance levels as well as gauging trend strength. For instance, in an uptrend, price often stay in the upper half of the channel, while in a downtrend they remain in the lower half. As you can see here, we are in an uptrend. You can see price remaining in the upper hand of the Keltner channel. And the key difference between both indicators is their sensitivity to price changes. Bollinger Bands react quickly to volatility, making them suitable for short-term trading. On the other hand, Keltner channels provide smoother signals which can be more reliable for long-term trends. When you combine these two indicators, you get a comprehensive view of market conditions, and I'll explain that to you as we talk about the strategy. So ensure you stay with me until the end of this video so you learn how to trade the Bollinger Bands Keltner channel trading strategy. So the first step is to trade using the Bollinger Bands and Keltner channel strategy. The first step is to set up both indicators on your chart, just like you're seeing on my chart. Use the standard settings for Bollinger Bands, and I'm going to just edit the Bollinger Bands and go to the standard settings. The standard settings is 20 period SMA and 2 standard deviations. And for the Keltner channel, also going to go to the Keltner channel. So look at my settings: 20 period EMA and a 2x ATR multiplier. So this setup allows you to identify periods of low volatility known as squeeze, where Bollinger Bands contract inside the Keltner channel. So you can see the Bollinger Bands, which is the thicker line, the thicker red and green lines, contracting into the Keltner channels during the squeeze period. So these moments often signal that the market is preparing for a breakout. As you can see here, we have the squeeze, have the breakout next. Have the squeeze, have the breakout next. Exactly. So if you look at the charts, you will see it. Well, when we're talking about the strategy proper, I'll show you more of it. We have the squeeze with the Bollinger Bands inside the Keltner channel, then the next thing we have is the breakout here, right here. So that is it for the squeeze. So the first step is to watch for the squeeze. When the Bollinger Bands move inside the Keltner channel, it indicates reduced volatility, and this is your signal to prepare for a potential breakout in either direction. The next step is to wait for the price to break out of both the Bollinger Bands and Keltner channel simultaneously. A breakout above the upper band suggests a bullish trend, while a breakout below the lower bands indicates bearish momentum and a bearish trend. Once you identify a breakout, confirm it with the closing price of the candle. For a bullish trade, enter when the price closes above both upper bands. So let's just look for a good example, which I'm going to use to explain this. I saw one here, so let's start with that one. We have the squeeze right here. This is called a squeeze, a Bollinger Band squeeze, and the Bollinger Band squeezed inside the Keltner channel, and it's expected that after the squeeze, price is supposed to break out of this channel either to the upside or to the downside, and we have price breaking to the downside and closing below both channels, signaling to us a potential opportunity to enter a sell trade from here with your stop loss just above the high, and you can set your take profit at a 1:1 or 1:2 risk reward ratio depending on your preference. So that is that for that trade. Let me look for a better setup where we have this, and we have one here. You can see this one where we have this squeeze right inside the Keltner channel. Have this squeeze where the upper band slightly moved inside the Keltner channel while the lower band moved inside the Keltner channel properly. And the next is this squeeze right here, the breakout. We have the breakout occurring here, and we can confirm that with the close below the channels, both channels. We could take our sales and our stop loss just above the recent high, which is this one, and you can set your take profit all the way down. That's how you can be able to take this trade. And we have another example right here. We have the squeeze. I used this example, I showed this example already. The next candle, using this next candle as our confirmation, entering a sell trade, and our stop loss just above that high with our take profits all the way down. So we've been talking about sell trades. Let's talk about bullish buy trades. And you have the squeeze happening around here. We have our squeeze here, and we can look to take a buy trade at the close here, and our stop loss is just below the low. We took a loss here, which is normal in trading. Losses are normal in trading, and it happens no matter the strategy you use. Now let's look for another example. You can see this example. This is a squeeze. We have the upper band inside the Keltner channel and the lower band inside the Keltner channel also. So we just look to take a buy trade from the candle confirmation after the breakout, and our stop loss below this low as usual, and our take profits all the way 1:1 or 1:2 risk reward ratio depending on your preferences. Now that's how we can enter these trades. We have another one here. We have this squeeze. We have the upper Bollinger Band, which is a red line inside the Keltner channel, and the green line, which is the lower Bollinger Bands inside the Keltner channel, and we should be looking for a breakout out of the both channels. And we have breakout to the upside here with price closing above that level. We just look to take a buy trade from here, and our stop loss all the way below. So I'll take profit levels at 1:1 or a 1:2 risk to reward ratio. That's how I would have been able to take this trade off of that level. So here we should always look at taking our trades. Also adjust your stop loss accordingly. For maximum risk reward ratios, you may shift your stop loss just a little bit higher, or at levels just below recent lows, like this one right here. So that is how you can trade. That's how you can trade using the Bollinger Bands, and the Keltner channel. So it's very easy. Just watch this video again, share it with your friends, and with time you understand. Alright traders, you've come to the end of today's video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.